Trade finance refers to the financial instruments and products that facilitate international trade transactions, specifically import and export activities. It involves providing financing and managing various risks associated with cross-border trade. Let's explore the finance of import and export in detail. Import finance. Import finance refers to the financial arrangements made by importers to fund their purchase of goods and services from overseas suppliers. Here are some common forms of import finance. Letter of credit, LC. It is a widely used instrument in international trade. The importer's bank issues a letter of credit on behalf of the buyer, importer, to guarantee payment to the exporter upon fulfillment of specific conditions. It assures the exporter that payment will be received as long as the terms and conditions of the LC are met. Documentary collections. In this method, the exporter's bank acts as an intermediary, collecting payment from the importer before releasing the shipping documents necessary to claim the goods. There are two types of collections: documents against payment, DP, and documents against acceptance, DA. Trade loans. Importers may obtain short-term loans from banks or financial institutions to finance their import activities. These loans are typically secured against the imported goods or other collateral and are repaid once the goods are sold. Supplier credit. Some exporters may offer credit terms to their importers, allowing them to defer payment for a specified period. This arrangement can provide financial flexibility to importers but requires mutual trust and a strong business relationship. Export finance. Export finance involves financial arrangements made by exporters to mitigate risks and receive timely payment for their goods and services. Here are some common forms of export finance. Pre-shipment finance. Exporters may require funds to cover production costs and fulfill export orders before shipment. Banks and financial institutions offer pre-shipment finance, such as export packing credit, to meet these requirements. The loan is repaid from the proceeds of the export sale. Export credit insurance. Exporters often face the risk of non-payment or delayed payment by overseas buyers. Export credit insurance provides coverage against these risks, ensuring exporters receive payment even if the buyer defaults. It enhances the exporter's ability to offer credit terms and expand their market reach. Export factoring. Exporters can opt for export factoring services, where a specialized financial institution purchases their accounts receivable at a discounted rate. This provides immediate cash flow to the exporter, and the factoring company assumes the responsibility of collecting payment from the buyer. Forfeiting. In forfeiting, the exporter sells its medium to long-term receivables, arising from export transactions, to a forfeiter at a discounted price. The forfeiter takes on the risk of non-payment and provides immediate funds to the exporter, typically without recourse. Export working capital loans provide financing for various export-related expenses, such as manufacturing, marketing, and shipping. These are some of the key financial instruments and products involved in import and export finance. The specific choice of finance depends on factors such as the nature of trade, relationship between parties, risk appetite, and country-specific regulations. Importers and exporters often work closely with banks, financial institutions, and trade finance specialists to optimize their trade finance arrangements.